Good morning. Welcome Beyond the SEAF Model. I'm Jack Kosar. This is effective for the week of November 3rd, 2025. Let's get started. SEAF signals for this week. We got technology, utilities, and healthcare. Technology is roaring this last week. Trading week 1, tactical month 1, strategic quarter 1. What does that mean? Highest score you could possibly get in the SEAF model with an overall ranking of 3. A little bit of weakness after that. Scores of 11 and 14 are not particularly high. And overall, we'll check this out in our heat map in just a minute, but overall, outside of technology, flows were not particularly strong in any sector on that trading week. Like I mentioned, with here financials coming in at 2, kind of not a misnomer, but just, in terms of how they ranked in, how we track the asset flows, while it is a rank of 2, it's not particularly strong overall. And then consumer staples coming in at last in general here. Going over into our heat map. As you can see here, a lot of red. A lot of red through the trading week, but a lot of red and yellow overall. What is that telling us? Technology came in at 1.13% increase on the trading week per our metrics. So that's quite strong here. Outside of that, the number 2 was actually an outflow, a negative 0.01. So in general, outflows, really across the board outside of technology. 3 out of the 5 days last week were down days, which means we had net outflows in the 11 sector spiders for a grand total of negative 0.04. So really, outside of technology, nothing really had any kind of inflows. Utilities and healthcare really being held up by their tactical month and strategic quarter here, where we have some accumulation. That's kind of what the model is designed to do. We really don't want to be whipsawed in any particular week by this trading week, because these numbers are very variable. Money flows in and out, especially going back this last year. We've seen a lot of pretty aggressive moves in terms of inflows and outflows in the 11 sector spiders. So this accumulation in the tactical month and strategic quarter allows this model to be a little bit more stable than getting whipped around by the kind of the impacts of the trading weeks. Moving on into my favorite chart. This is the sector spider total AUM. So if you add up the 11 sector spiders, AUM, you get this number up here, which we're crowding in on that $340 billion mark. We have a 21-day moving average, and we have a price chart of SPY. Why is this important? Because at least for the last year, the AUM in the 11 sector spiders has done a pretty good job of adhering to its 21-day moving average. That meaning when we're above the 21-day moving average, we tend to have price appreciation in SPY. When we're below this 21-day moving average, we tend to not. You can see here a couple of different marks when we've dropped a bit below. There were minor bottoms. And when this chart gets blown up a little bit more beyond than just the last couple of months, you can see that sustained periods of under 21-day moving average tend to be downtrends in the S&P 500. It means money is leaving the 11 sector spiders. We like this a little bit more sometimes than some of the other AUM metrics, because I feel there's probably a little bit less options trading done on the 11 sector spiders, and potentially get a little bit more of a clean result as it comes to the overall direction of the market. So I track this. As you can see here, we came off a high mark around 344 billion just a couple of days ago, kind of pulled back a little bit from that, sitting on around that 340 mark, but still significantly above its 21-day moving average. So something to keep an eye on. We're going to, I think in general, I like this chart describing not only the SEAF model, but how we see these flows and what they mean to us overall for the broader market. So that's the sector spider total AUM chart. Moving on to our rainbows. Going to start with consumer staples. They're actually our lowest ranked sector. Really been in a deep decline in its underperformance versus SPY. Up top, we have the daily scores of the SEAF model, and then here on the bottom, we have the relative performance versus the S&P 500. Just continues its downtrend. We had these little spikes up into trying to touch into favor, spending a little bit times in neutral. Those have resulted in little moves relative outperformance here and there, but overall pretty steep downtrend in this consumer staples that started going back to really early April of this year. So consumer staples continues to be a place to avoid. On the reverse end, technology. The name of this video is going to be Technology Roars, and that's really that 1.1% inflow on the trading week to kind of go with some real strong accumulation through the tactical month and the strategic quarter. As you guys can see here, really dark greens on top, showing off here for technology. So what, again, what is that telling us? Asset flows ripping into technology, spending a lot of time in this upper favored. What has that done for us? A lot of relative outperformance versus SPY. This looks extremely strong, strongest one that we have in the SEAF model at the moment. So technology looking really great. Obviously, this is driven really strongly by AI, and then recent, return or recent quarterly numbers for the big Mag 7 big tech companies coming in pretty hot as well. So a lot of strength in technology at the moment. Utilities, as we kind of mentioned earlier in the video, and I'm going to just run these kind of side by side because they're a similar story. Utilities and healthcare showing, this lower favored, kind of move. Not a lot of inflows in the trading week, showing a little bit of accumulation that had got us into upper favored in both, that resulted in some relative outperformance versus SPY. Obviously, utilities had a little bit of a pullback here. Look to potentially have found a bottom on this one, and similar thing for healthcare. The SEAF model is going to put you in the sectors that really have overall through multiple time periods shown velocity of money moving in. Sometimes that results in some of these higher scores where we do see money flowing in, but potentially not as strong as something like what technology is doing at the moment. So showing utilities, mid to low favored. Hopefully picking up, we can get some extra flows coming in. A lot of times utilities has kind of been sitting on the fence in terms of whether it's going to be a AI stock or whether it's a defensive stock. But as of right now, utilities and then also healthcare showing some flows coming in, a bit tempered, a little bit of a sideways move here in healthcare, but they are still SEAF signals because we never know. Again, this isn't a projection tool. We're not going to say, hey, I know exactly what's going to happen next week. We're just trying to put clients in the right situations to take advantage of money as it flows into these particular sectors, especially over 3 time periods. Again, so it's not super jumpy on the trading week where we're seeing, sectors flowing in and out based on 1 week's flows. They've been very aggressive this year in terms of money flowing in strong and out strong. You can see that happen here with healthcare. Healthcare went from avoid to neutral up into favor. That was a big, strong move for healthcare. That money has, we've been a little bit of a sideways move from there. So we'll have to wait and see what flows are going to look like next week for healthcare and utilities. But yeah, that's all I have for this week. I look forward to breaking down the SEAF model with you all next week, and thank you.